Certificates of deposit, CDs, are a robust savings instrument that, while straightforward at first glance, offer a wealth of strategic opportunities for savvy investors. Understanding and deploying the right CD strategy can be crucial for those aiming to optimize their investment in terms of return and liquidity, particularly in a fluctuating interest rate environment. Below is a more comprehensive look into CD strategies, their implementation, and how to maximize your investment potential over time. Extended insights on CD strategies. Advanced CD ladder strategy. The CD ladder strategy is not just about spreading out investments evenly across different maturities. Investors can customize their ladders based on personal cash flow needs and interest rate expectations. For instance, flexible ladder. Instead of equal investments, allocate varying amounts based on expected future cash needs. Larger amounts can be placed in CDs maturing around times when funds will be needed, and smaller amounts in others. Responsive ladder. Adjust the rungs of the ladder based on shifting interest rates. For example, if rates are expected to rise, you might concentrate more on shorter-term CDs to take advantage of higher rates when they mature. Expanded barbell CD strategy. The barbell strategy can be more than just a simple division between short and long terms. Consider a dynamic approach where the proportion between the short and long ends can be adjusted based on market conditions or financial goals. Active barbell. Regularly rebalance the weights of the short-term and long-term CDs depending on current interest rates. If rates are rising, increase the weight on the short-term side to take advantage of renewing at higher rates sooner. Comprehensive bullet CD strategy. A bullet strategy is typically used for targeting specific financial goals, but it can also be adapted for more complex financial planning. Staggered bullets. Instead of having all CDs mature at once, plan multiple bullets aimed at different goals or times, creating layers of maturity that provide liquidity and fund availability at various stages. Goal-oriented bullets. Integrate your bullet strategy with other investment vehicles. For example, shorter maturity CDs can be used for near-term goals while aligning longer-term CDs with investments like bonds or stocks that mature around the same time as longer-term financial objectives. Beyond traditional CD options, exploring alternatives. In addition to traditional fixed-term CDs, several alternative types of CDs can provide additional flexibility or yield optimization opportunities. Zero-coupon CDs. Instead of receiving annual interest payments, these CDs are purchased at a discount and mature at face value. They can offer higher effective interest rates, but require holding until maturity to realize the full benefit. Add-on CDs allow investors to add funds to the CD during its term, which can be useful in a low-interest rate environment where future rates are uncertain. Callable CDs. These often offer a higher interest rate in exchange for the bank's option to terminate the CD before its maturity. Suitable for those who can bear the risk of early call in exchange for higher returns. Optimizing CD investments. Strategic considerations. Interest rate forecasting. Keep an eye on economic forecasts and central bank communications which can indicate future interest rate movements. Diversification. While CDs are safe, they should be part of a broader, diversified portfolio that may include stocks, bonds, and other assets. Tax considerations. Understand how interest from CDs will impact your tax situation, especially if you are in a higher tax bracket. Continuous learning and management tools. Financial newsletters and webinars. Stay informed about the latest trends and advice by subscribing to reliable financial newsletters or attending educational webinars. Sophisticated financial calculators. Utilize advanced online calculators that can model different scenarios under various interest rate movements, helping you to strategize effectively. By deeply understanding and thoughtfully applying these advanced strategies and considerations, investors can not only enhance their returns, but also align their CD investments more closely with their overall financial objectives and economic conditions. This nuanced approach can lead to a more effective and responsive investment strategy, maximizing both growth and financial security.